So from the previous video, we were talking about UJ, and I said that we do expect a move to the upside for UJ, but that is not likely to just happen all at once. What could happen, because there is a large amount of accumulation and sideways compressional movement, we can see something like this occur where they raid the liquidity sitting below here on UJ, because there is, if we look on the daily, that these stops, okay, sorry, they have been taken, so that's irrelevant now. But we can see here, if we look on UJ, that when price came, there was these lows over here, and this liquidity has now been raided on this point here. So actually, I didn't see this wick here. So this wick closed out all of this liquidity and bounced off of this daily order block, creating another daily order block over here. So we can say that on the daily time frame, UJ looks bullish, and on the weekly, we can see that there is a bullish order block over here and a bearish order block over here. But we have some upward momentum to be able to push price into. So we can still push price up for at least 100, 200 pips, and before we see a move again to the downside based on the weekly chart. But there is a large amount of imbalance in price here on UJ. So we can see that this liquidity void over here on UJ will be filled before we can see additional reaction to the downside. So I would expect price to come in here. So if we follow the order flow from this move to the upside, this candle here would have been our breaker. Okay, so we can expect price to come to this bullish order block that created the breaker. And obviously we have our source over here, and this can also be tested. So if we look here, the fair value gap or liquidity void that sits here is surpassing our or sitting inside of our fair value gap, and there is a 4-hour order block over here. So when price gets to this level, we could see an additional reaction to the downside for UJ because of the weekly chart indicating to us that it is very bearish. We can see here that this is a bearish order block, and price wicked into the 50% over here of this order block, and price fell from that area on the weekly chart. So that indicates to us that overall time frame, it is bearish on the weekly. And just a quick look on the monthly, you can see again another order block at the top and another order block below, and price wicked into these order blocks and fell. So the higher time frames are telling us that UJ is bearish. The daily chart is telling us that UJ is looking bullish, and the 4-hour chart tells us that it is looking bullish. Okay, but based on what I've told you, is that because there is still an accumulation here, we can see a move to the downside and then a strong move to the upside like this, because banks are trapping or accumulating orders here. So there's a whole bunch of liquidity still sitting here on the 4-hour chart, and the banks might want to wick down first and then ride up into our breaker or our order block or our source, or all three of them. But this fair value gap needs to be closed, this breaker can still be tested, and this source can still be tested. So anywhere from these areas, we can look for downward momentum based on what price action is doing. Our breaker, close of our fair value gap, our source, and our bearish order block. My guess would be on this is that for our bearish order block we have here, actually this is also a bearish order block over here at the top. So generally when this kind of movement happens, we can expect a retest possibly of this 4-hour order block, close of our fair value gap, having tested our breaker, and then move to the downside. But I would see this gap being closed because even on the daily chart, there is huge amounts of imbalance in price. Okay, so it is even possible for price to come and close this large daily liquidity void above our source and our breaker. So that is also something to keep an eye out, but we only trade price action. So obviously once price on UJ closes above our source over here, then we can look to continue to buy into our fair value gap. And it is basically a given that they would at least close 50% of this fair value gap on the daily chart, or liquidity void at least, because you can see here that this liquidity void was filled over here and they only tapped into about, I'd say 20% of that fair value gap, and there is still a large amount of it open. So keep an eye out for that. Okay, next question is from, okay, we're going to do the scalping last. Eddie, you asked, I still have difficulties in taking entries. My question is, if I look at 4-hour time frame, which time frame is best to take entry? Okay, well, let's take an example of.
Hello.
Okay, yeah. So I'm just going to show you how to do it.
I have a question. Hello.
Yes, I hear you. Hello? Jude? Okay, well, let me answer Edidem's question. So his question is, if he's, my question is, if I look at the 4-hour time frame, which time frame is best to take entry? Well, based on what is happening on the 4-hour chart, we would have obviously marked up our order blocks. So either we're looking to follow the order flow in a bearish or bullish bias. And in this scenario, we are looking for a bearish scenario. So, for instance, here is a perfect example of AU, and where price could have, or you could have used the order flow strategy to take an entry on AU. Okay, so we've marked up our bearish order blocks, okay, over here, and let's just add in our breaker over here. So we're following the order flow, and this would be our source candle over here, this peak formation high. And now we are following the order flow, these red boxes, 1, 2, taking price back down. Okay, you can see price tested our breaker. Our yellow box is our breaker, and price tested it, creating this order block to the downside. Okay, price then created another order block on AU over here. Okay, when it created this order block over here, and we are following the institutional order flow that it is bearish, now let's go look on the 1-hour time frame to see where we could have got a good entry. Well, this is the 1-hour time frame, and if we had seen here that this small area is a fair value gap on the 1-hour time frame, we can see that this is also a bearish 1-hour order block over here. So this is a bearish 1-hour order block, and I'm just going to make the 1-hour order block pink, and the fair value gap on the 1-hour I'm going to make purple. So here, this small area is a fair value gap. So we have 2 4-hour bearish order blocks, and now we have a fair value gap on the 1-hour. So Eddie question is, how do I know now that if I've looked at the 4-hour chart, where do I take my entry? Well, I've marked up the order flow on the 4-hour bearish order flow on AU, and now I'm on the 1-hour time frame. I've marked up this 1-hour bearish order block on AU, and I also see that this purple box here indicates a fair value gap. So when price rallies down massively, and we see here that this move is 92 pips, we see that price retraces. Okay, where does it retrace? Well, this whole liquidity void or fair value gap, however you want to label it, will be closed. So although it doesn't get closed here, and this is about the 50% level of this gap, we can see price reacting and going down. But essentially, if we pull our fair value gap across here, we can see price wicking into our fair value gap over here, 50% of our 4-hour order block and the opening candle of our 1-hour order block. So what does this tell us? Exactly, this fair value gap was closed. Sorry about that. So this fair value gap was closed on the 1-hour chart, and we could have entered on the opening candle of the 1-hour chart, and we would have been taken in for an entry. So I've marked up the 4-hour order block, the 50%. We could have had a limit there at the 50% of the 4-hour order block, or the close of the fair value gap on the 1-hour. So, I mean, if you'd taken an entry here at the close of this fair value gap and you put your stop at, say, 30 pips, well, boom, 80 pips for you. That is an excellent trade. And I personally took this trade, so this is why I'm using it as an example. But many trade setups formulate themselves once you follow the bearish order flow. And these gaps appear on multiple time frames. You won't see everything on the 4-hour time frame. The idea is that you frame up the order flow on the 4-hour. You either take an entry on the 4-hour opening candle of the order block or the 50% if you want to, and you put your stop above the order block, you can do that. Or you can even refine your entry further by going down to lower time frames, just like we did here. So if we look on the 4-hour chart, we followed the order flow. We created our breaker. We had a bearish order block creating the breaker over here on this candle. Price rallied upwards, creating our source, creating a bearish order block inside of this bearish order block. Price rallied down. Price rallied back up, tested our source, created a 4-hour bearish order block over here. So this is an additional confirmation that price is still bearish because it is testing our breaker. So once it tested our breaker, created this first bearish order block after our breaker and the second bearish order block after our breaker. Then I went to the 1-hour time frame and saw that there was a fair value gap over here, 1-hour order block over here. Price rallied down, came back up, closed this fair value gap, tested the opening candle of the 1-hour order block, and boom, there you go. Sure, if you're a swing trader, maybe that's not enough pips for you, but if you are intraday trading, 80 pips is decent. Sometimes I don't even make 100 pips a week. I don't care because I use larger lot sizes with tighter stops. It's all about your lot size versus your risk reward ratio. So regardless of if you catch 1,000 pips, 100 pips, 10 pips, it's the value per pip that matters. Okay, so if you are getting good at this, you can use a 10 pip stop loss. There you go, 10 pips. And what is this? This over here, let me guess, is probably an institutional level of 200. Well, there we go. We have a 4-hour bearish order block, one confirmation. We have another 4-hour bearish order block as a confirmation. That's 2 confirmations. We have a breaker that was tested and rejected. That's the 3rd confirmation. Inside of the 4-hour order block, we have a 1-hour order block, another confirmation. So that's 4 confirmations. Then we have a fair value gap and a close of a fair value gap. That's 5 confirmations. That is an awesome trade. Retail traders may tell you that, oh, I took this on the closing above the crossover of a 200, a 100, and a 50 EMA, and I took it with a 50 pip stop loss. Cool, great stuff. Go to another channel. We are here, we are trading institutional order flow, and this is the epitome of a great trade. And anyone that tells you otherwise, well, then they must come and show me how to trade, because at the end of the day, we are here to make money, and this would have been a great, fantastic setup on AU. Not only that, we had a second time where price tested our fair value gap to balance it further, and price fell down, and it is continuing to fall down at this level over here. And that is how you can use multiple time frames. And you can even go lower to the 30-minute. But the same is applicable to what I just showed you, whether you use the daily, the 4 hour, the 1 hour, the 15, whatever time frame. You frame up your entry from the top down. So you need to know where your order blocks are. You need to know the institutional order flow. You know your fair value gaps, institutional price levels, sources, breakers. All of these concepts are confirmation why you need to take the trade. So every time you take a trade, tell yourself, how many times can I convince myself on this particular trade? Is it a good trade? Do I have 2 reasons, 3 reasons, 4 reasons why I'm taking the trade? Next question. So I think Eddie, you can go back on the video, and I'm sure I've told you how to make a good entry. Next question. You talk about using limits for OBs. Does it mean that you can use something like buy stops or sell stops for things like fair value gap and liquidity void, since it helps one to understand that a particular gap will be closed? Daisy, a CEO, I do not use buy stops and sell stops because you are getting in at current market price, and I do not like to trade unless I take an executional order. I don't trade at market price. You will take a sell stop or a buy stop based on the framework of the trade or the setup that you have created for yourself. Don't use buy stops and sell stops. There is very limited places or setups that would be applicable for a buy stop, because a buy stop enters you at the market price where price is heading, instead of going up and take the sell limit and then coming down, and then you are filled in your sell limit. So you want price to go up, then your sell limit is hit, and then you want price to drop. Whereas a buy stop is you want price to continue upwards. You entered into your trade and you're hoping trade will continue upwards. A buy stop is not as good as a buy limit. You want price to come down. So let me just depict this on a area of this chart. So if we place a sell limit, we want a sell limit to come to this red line, price to come into our sell limit, and then price to continue down. If we enter a sell stop, we want price to continue down, entering us on the position, and hopefully the price will continue down. We want to sell at a premium price, not at current market price. We want to sell at
5 minutes. I'm going to go 5 minutes in the class.
Please mute your mics. Thank you. And price rallies up, and then you enter for your sell limit. You do not want to take a sell stop. You want to take a sell limit, or in reverse, you want to take a buy limit. So here is your buy limit on this horizontal line, and you want price to trade into your buy limit and then price to bounce off of your buy limit. You do not want to place a buy stop, hopefully that when price trades into your buy stop, price continues past your buy stop, taking you into profit. No, take a buy limit or a sell limit. It is better, promise you. And if you can identify and practice, you will see the benefit of using a buy limit and a sell limit. I generally don't tell people to use buy stops and sell stops based on the fact that This is retail and we don't really trade breakouts as such. So you don't want to see breakouts. There are certain scenarios that I will cover in the future of where it is applicable to place a sell stop and a buy stop, but it is very limited usage. You'll find more value in using a buy limit or a sell limit. Okay, I think I don't see any more questions. I do have others. Does anyone want to ask a question while I'm looking for others?
Hold on.
Hello, yes.
Hold on.
Yes, I can hear you.
Yeah. Is there a way we can determine how long the price to move to our buy limit or sell limit? Let's say we place our buy limit at a particular point in time, and then we want to know when price will reach. Is there a way we can estimate when price will reach that's our buy limit? Our
No,
orders.
the only way to effectively use a buy limit and a sell limit is to practice what some people find very difficult is patience. So I have had cases where I've placed a sell limit or a buy limit, and I did this on, say, a Monday and a Tuesday, and only the following week my buy limit or my sell limit was activated. But because I practiced patience on this particular trade and I didn't delete the limit, I was taken for a really good trade because I practiced patience. Remember, the broker doesn't charge you to put your limits. So you can have a couple of limits just sitting on your account, obviously hoping you followed your risk management portfolio and your trading plan. There's no reason to not have limits at any given time. So at any given time on my personal account, I may have 2 to 3 limits just sitting there waiting to be executed. And the only way those limits become invalid is if, when it gets activated and price is not doing what you are expecting it to do from that limit. But the best thing to do is practice patience on the limit. If you set a limit or a buy limit or a sell limit, patience. You have to wait for the trade or the price to come to you. Do not get the fear of missing out and saying, oh, I missed this trade, I'm just going to sell now. That is a bad trade waiting to happen because there will be other opportunities where you will take market execution instead of a sell limit. I'm not telling everyone to go now only trade sell or buy limits. Maybe have a sell and a buy. One execution, one limit. It's up to you.
Okay.
It's
Thank you.
it's important. It's important
Yeah.
to use limits because it is giving us another confirmation that we are willing to wait for price to come to us, and then we will be taken into the order. So instead of us as the retail traders chasing price, having used an executional order, we are being patient and we are waiting for price to come into our setup that we've formulated on the chart and be taken into the trade. Generally, you'll find that when you are patient and you've had your execution versus your limit, the limits will have very little pips against you if it's a good setup that you found, and price will do exactly like you thought if you are following the strategies and you have marked up your chart.
Okay, thank you. What's the best time frame to place trades for an intraday trader?
Okay, so that's up to you as well. It depends what your trading plan decides for you. So if you're a person who wants to catch 10 pips on each trade or 30 or 40 or 80, it's entirely up to you. So obviously being an intraday trader, you need to pay yourself. So the important factor in intraday trading is not to be greedy. So if you have a trade running, say, in 40 pips profit, move your stop loss past, say, 20 pips so that you're at least paying yourself 20 in the hope to get 60 or more than 40. Okay, so knowing your setup and where price can go to is important for your setup. There isn't a best time frame. You can trade on any time frame. It depends on if you're a scalp for the intraday or if you are trading the trend for the day. So what I mean by this is, like an example here I made on AU, where we took a trade based on the 1 hour over here. And if we look here, and we bring up our days, we can see that if we had been entered on this trade over here on our limit and we had taken and ridden price down, we would have made 50 pips, but then price retraced. So up to you as the trader, if you see price retracing, generally back to your entry, you want to have either had taken profits or be willing to wait the next day for your setup to continue, because price will go up and down. This is how the market works. So generally, if your setup is good, you need to be patient. You can't just say, oh, price is going against me, I'm going to put my stop at break even, and then I get closed out at break even and my setup plays out exactly the way I had thought it to play out. So it's important to look from a larger time frame to know where price can potentially go based on the day or based on the higher time frame, and then decide once you're in the trade where you want to enter or exit or continue the trade. So generally what I do is I take 2 positions or 1 position based on the setup. So I'm not telling you now to go take 10 positions or 5 or 2. Take a position, and if you see the trade playing out and maybe there's another order block or another confirmation, add to your position so you can have 2 positions, 1 at break even and say 1 at 20 pips or 30 pips. But if you're intraday trading, generally you want to catch a minimum of 30 pips, depending on your lot size again. So that depends on your account too. You know, if you can take a 2% account with say $1,000 and you have a 15 pip stop loss, well, then you can run a 0.10 or 0.15 lot size, no problem, 2% risk. There you go. With a 40 pip TP, that's $40 for you. But if you can sustain yourself on a 2% account, $10,000 account, 2% risk, well, then you can use a 1 lot size with, say, a 10 pip or 15 pip stop loss, and you bank $400, $500 on the trade. So it depends on your account. It depends on how do you have the screen time to sit on the charts and be able to make the trades that you want to make. So if you have a day job, maybe it will interfere with your trading. So my general consensus on that is that if you are working and trading, make sure that you check your trades. Don't just leave them. And, you know, if you have a sell limit, check it every now and then to see where price is near it, but always book profits. Don't go and be greedy and say, oh, trade's running 50 pips, I want 100. And then the trade goes against you and then you lose all the 50 and you pay yourself nothing. At the end of the day, you need to pay yourself. So whether that includes closing half your lot size at 50 pips and leaving the rest at break even, well, then that's cool too. It doesn't matter as long as you're paying yourself. And the time frame, like I said, as long as you know the directional bias on the 4 hour with the order flow, whether it's bullish or bearish, you can trade any pair as long as you know what the bias is and what direction you want to trade. Everything I just showed you on AU can be used on lower time frames. Okay, so we have, hopefully that's answered your question. I have another question here, and that is someone who wants to know about the 15-minute. So, okay, cool, no problem. Let's do this. So the 15-minute, let's just clean this chart up and look at the 15-minute time frame. So based on the 15-minute, first we need to find out what direction we should generally trade into. So on the 15-minute, well, this is first a 4 hour, so we just mark up our bias. So this is a bearish order flow, and we mark up our order blocks. Okay, so we've got 3 order blocks, and price is generally in the downward direction. Then we can look at the 15-minute chart based on our 4-hour order block. Okay, so if we go here to our 4-hour order block, we can see that once we are created our 4-hour order block, we can expect price to go down. Now, when we get back into our order block, so here we can see this area here of the chart. Let's go down to the 15-minute. When we get to this area of the chart and price starts to retrace back into our 4-hour order block, the same is applicable for when the order flow on the 4-hour or the 15-minute. So what do? Well, we know that this red box over here indicates our 4-hour order block, and we also know that we marked up our chart with institutional price levels, so we will know when price gets to our institutional price levels, our order blocks, we can expect reaction. So based on that, we can see that our order flow changes. Okay, so let's look here. Price goes up into our 15-minute. We create this bullish order block into our 15-minute chart. Okay, so price follows this order block into, I'm just starting here because this is where we can start to look for a trade. So price goes up into our 4-hour order block, and we can see rejection. And also this is a recent institutional price level. Then price gets to a point where it cannot go any higher and bounces back down. Notice where price bounces off is our 15-minute bullish order block over here. So price goes through our order block. Then price falls and trades and closes 1, 2, 3, 4. So that is 1 hour based on the 15-minute chart. So 4 15-minute candles represent 1 hour, and this is a 1-hour order block. Okay, so when this order block gets created, we can expect price to retest the highs over here, because we know that this is a order block. So this is a 15-minute order block over here. And if we go look at the 1 hour, well, like I said, without looking at the chart, this is a 1-hour order block based on what is happening on the 15-minute time frame. So I didn't look at the 1 hour, but I still told you that this is an order block. Why? Because these are 4 down candles of 15-minute representing 1 hour. So we have a 4-hour bearish order block here, and we have an institutional price level. Price fell down, rallied back up. When it rallied back up into our 4-hour order block, we can see a continuation of wick rejection. Look how much wicks are here. 1, 2, 3, 4. So over here, this is our institutional price level, and when price came here again, it was consolidating. There was no new higher highs created here. So again, this is giving us an additional confirmation we can sell here, because we have a 4-hour bearish order block and a 1-hour order block and a 15-minute order block. Look, this is a 15-minute order block inside of a 4-hour order block. Right here. This here is an order block. So if we mark that up, look how price was contained inside of this order block, sitting inside of this 4-hour order block. So there's a 15-minute order block inside of a 4-hour order block. Boom, price goes down from that level. So you may ask, well, why does price go down there? Well, because it's 4-hour order block, there's a lot of orders that are bearish for the sell inside the zone. So you had 2 opportunities to sell. Look, price came here and made this low and rallied back up into our order block. Price didn't close above our 15-minute order block. It didn't even close above our 1-hour order block. So you sell. Simple as that. And this can be done over and over again. All you need to do is, the best way to do it is doing what I just showed you using the 4-hour system. So 4-hour bearish order block. Then let's clean this chart up and see if we can find it using a 1-hour. So let's go to recent price data on EU, and this over here, let's just go back in time a little bit to say here. So let's mark up this 1-hour order block over here and see what happens on the 15-minute chart. Okay, so previously on the 15-minute chart, this would have been an order block. Why? Well, because price traded through this order block on the 15-minute. So that is a bearish order block. Okay, so price came down, traded sideways. We know that this is a 1-hour order block over here. Price then fell below, continued below. We previously know that this was a 15-minute order block. So this becomes a breaker. Even though it's a 15-minute chart, breakers still apply. And now we have a 1-hour order block. So when price creates this breaker on this candle over here, we can expect and wait for a retracement. Where's our retracement? Well, right there on that candle, just like that. And again, 15-minute fair value gap right here. Fair value gap right there. 15-minute. Price closes that fair value gap. Boom, sell right there. So you have a 1-hour order block, you have a 15-minute breaker, fair value gap closed, sell. Look at that. Sell. And if you're scalping, well, there's 35 pips. Again, sell again. 42 pips. Sell again. 45 pips. And this can be repeated over and over again. Well, let's look. Fair value gaps can be even traded. Well, let's look here. So at this zone over here, let's say that there was a 1-hour order block here, and we can expect a move to bounce up. Okay, well, let's enter a trade. Where is our TP? Well, there's a fair value gap here. Here's a fair value gap over here. Here's a fair value gap over here. These are price target areas. Here's another fair value gap at the top over here. Boom, look at that. Perfect. Nice TP on this peak formation high over here. The same thing I've showed you on higher time frames applies to lower time frames. All you need to do is just mark up a higher time